right, welcome everyone to tonight's Sunday macro wrap up for Sunday, October 26th. Lots of information to go through today. Busy week coming up this week in the context of macroeconomics and strategic positioning. So let's go ahead and get right into it here. For those who are joining live on our social medias, welcome. The way that these Sunday macro wrap-ups work is that they're an hour long. The first 30 minutes is streamed on our social medias, and then the last 30 to 45 minutes is actually offline, just for our macro investing community members. And so if you guys would like to take a look at that, just go to our website, and we have some different options there for you to take a look at our community and learn more. But yeah, pretty interesting couple weeks. We're on day, 26 of the government shutdown right now. And so, this is now the second largest or the second longest United States government shutdown in U.S. history. And so if this goes until November 4th, that would tie it for the longest government shutdown, the previous one being starting in December of 2018 and going into the end of January of 2019, if you guys remember that. And then if it goes until November 5th, it'll officially be the longest government shutdown in U.S. history. But it's not like that's been a huge, component to the market or a huge headwind to the market, because the market's been doing great. And it's almost like a lack of this, potentially catalyzing information with inflation and the jobs market has been keeping it going up. And in fact, if you looked at the previous government shutdown from 2019, there was a pretty large sell-off heading into that. And then once the government shut down, the market rallied, I think, like 17% in that 1 month. It was one of the best months in S&P 500 history. So, I mean, government shutdowns typically are kind of bullish for the markets for the most part. But but anyway, we had a pretty interesting week. I'm not going to get too into the geopolitics of a lot of the different tariffs and things like that. I know that, it's kind of like whatever the headline and whatever Trump decides to tweet, that those are pretty much unavoidable obstacles that just pop up in front of the car out of nowhere. And so you kind of just have to navigate that. But that's why it's important to stay a little bit defensive in this market, but really having, exposure to bullish assets, which, the green light remains on in the bookshelf in the background there, which means the S&P 500 is in a bullish trend. If it's yellow, it's neutral. If the color on the bookshelf is red, it's in bearish trend, but it's been bullish really since May, I think it was May 15th. It's stayed bullish trend. And so, yeah, despite the crazy fear in the markets, especially with sentiment still being bearish for some reason. I don't know why retail investors are so scared of the markets. They got to stop. They got to turn off, Fox Business and CNN and a lot of those legacy CNBC, a lot of those legacy medias, and just take a look at the trends. But lots of interesting things going on right now. Let's go ahead and get into some of the macro data this week. Actually, before that, let's just take a look at some of the different performances over the past week. Last week was pretty interesting. We had actually a big jump in oil prices. Oil is this line right here in gray. Oil was up 8.85%. The S&P 500 was up 152 basis points. And then what else did we have here? Bitcoin is still having a little bit of a struggle, but that remains in bearish trend. Gold had a decent sell-off, which provided some opportunity there. It did have a little bit of a pop end of day, but yeah, and then the dollar also remains in bullish trend. But the best performing asset last week was in U.S. oil. And then when taking a look at the different sectors of the S&P 500, the best performing sectors last week were tech with XLK and industrials. So tech and industrials were the only two sectors out of the 11 that did better than the S&P 500. Actually, let me put these up too. I take that back. Energy also had a decent week, as that also reclaimed bullish trend. So XLE up 2.43% last week. Month to date, looking at the different sectors, healthcare has actually been a really good sector, along with utilities and tech. Those are the three. Those are the three sectors in October that have beat the market. So again, healthcare, utilities, as well as the tech sector. All right, so taking a look at some of the macro data that we got this week, the title of this video is "The Fed to Cut Rates as Market Celebrates a Soft Landing." That's really what we saw last week with the S&P 500 making new all-time highs, is that, we did get inflation data finally for the month of September after the government shutdown. I guess they just decided to release it because they wanted to. But, core inflation actually went down. And so that was one of the big metrics that the market was anticipating, and the market was thinking that it was going to have a large acceleration. And so seeing that core inflation actually went down, this fuels the narrative of a soft landing, which for those of you that need an actual definition, a soft landing when coming out of a state of high interest rates and high inflation is when you do have a slowdown in growth initially, but then there's a nice recovery. So growth starts to trend upward, while at the same time, you have inflation continue to disinflate, right? And so what that means is that it continues going towards that 2% target. And so if you have growth remaining okay and inflation's coming down, well, that's a Goldilocks type of market, right? That is a soft landing. And if that happens, then that also instills continued trust in the Fed as well as the government. And so if that happens, the market is really going to like that. And so far, that's really the type of data that we've been getting. And so a lot of people have been asking like, hey, why has the market been doing well? Well, it's because of the soft landing narrative continuing to be, reinforced with the data that we're getting. Now, you do have to remember that typically, these soft landings happen first and then they turn into a hard landing, right? So inflation starts to come down and, the market celebrates, and then it keeps going down and the market's like, wait, no, inflation, don't go down too much. Don't go into deflation, because that's typically a sign that the market's doing poorly. And, you do run the risk of that happening. And that's typically what happens, looking at history. Not all the time, though. There's been a couple times in recent, history where, you did have a soft landing. I believe that was like in the early 2000s, I believe it was, where there was a soft landing, like 2002. So where the Fed lowered rates, inflation came down, and there was no recession. Of course, the recession did come a few years later than that. So, it'll probably be just a can kicking moment. But for the time being, there's no point in trying to guesstimate when, there's going to be a crash or anything like that. And so that's the main message that, my team and I have been giving to our community as well. It's like, look, there's no point in trying to pick bottoms. There's no point in trying to pick tops. Really, you just want to make sure that you are owning things that continue to be in a strong bullish trend. And then when things stop making you money, or when things start to roll over, that's typically a good sign to, then reshuffle your portfolio. And it's like, it seems very basic, but so many people try and overthink it. And it's kind of like, those crash diets where you take, a magic pill to lose weight. And so they try these day trading techniques or whatever, and they end up losing money. You don't need to do all that, right? It's just about looking at the trends and owning bullish trends and not owning bearish trends. Anyways, getting into some more of the data from last week that's been reinforcing this soft landing narrative. We also saw that, existing home sales actually rose for the first time in a while. So as you can see, over 4,000. Or that's not 4,000. I think it's 4 million there. 4K thousand. So that's million. Existing home sales increased in September. That's the highest since February of 2025. If you go back 5 years, I think it is pretty low compared to where it was here, right? But still a little bit of an acceleration there as rates start to come down. We also had S&P Global's manufacturing PMI, which did also accelerate there. So that also remains high, and that's been accelerated for the past 3 months. We also had the S&P Global Services activity, which also accelerated there to since April. Um, Going back, we can see that that's been in a general uptrend. It had a pretty big decline post election, right? So we had a steep decline in January and February of this year, and then it remained sluggish, and now it's finally picking back up again. So again, if you're getting better growth data, even if it's not really bad, if it's better than expected, or not as bad, then that can be looked at as a positive rate of change, which is good for this type of soft landing narrative. And then we also saw how core inflation, like we mentioned before, came in below forecasts. This is actually headline inflation here. So headline inflation did go up to 3% from 2.9%, which is the highest since January of 2025. But that was already pretty much priced into the market, right? If it came in above 3%, then you probably would have saw a negative reaction there. But really, all eyes were on core inflation, which, like we mentioned before, actually came down from 3.1% to 3.0%. Now, that was already priced in as well, so I'm not sure why the market had the type of positive reaction that it did, because again, it was pretty much expected there. Um, but what's interesting, we do see that core inflation could remain at that 3% number for maybe the next couple months here. We have core PCE coming down though. So remember core PCE, this right here, that's the essentially the main inflation measure that the Fed looks at for their monetary policy, and that's actually being calculated to come down. I believe we're supposed to get core PCE this Friday, but again, with the government shutdown continuing, we may not get that. But still, you can look at other types of inflationary measurements there. Who knows? We might get it though. But anyways, the moral of the story is that you have real data showing a little bit of a deceleration in inflation, while at the same time, and we'll look at this in a second, but we also see that according to the bond market, looking at the 5-year break-even inflation rate, that's actually been coming down as well, even though it did have a little bit of a rebound recently, but we can take a look at that in a second. And then what else did we get last week? The 5-year inflation expectations for the University of Michigan survey did accelerate, but that survey has really not been the best indicator. So, yeah, that could remain higher, but who knows? Now, what I did also want to touch on is sentiment, not just with retail sentiment, which we kind of talked about a little bit earlier, and they remain surprisingly bearish. Who's been remaining incredibly bullish has been fund managers, right? So if you take a look at the most recent Bank of America fund manager survey, you can see that sentiment rose to 8-month highs, not as much as when Trump was elected this time last year, or anywhere close to the November 2021 highs. But as you can see, it's had a pretty stark rebound, right? Yeah, the tariff tantrum earlier this year had a pretty crazy drop down, but it's since recovered, right? So fund managers are pretty bullish, meaning that they expect growth expectations to continue to accelerate. Cash levels are coming down, and which means that they're more allocated to the equity markets. Taking a look at the actual cash level that these fund managers have, you can see these two horizontal red lines here, one at 5% and one at 4%. The 4% level is kind of like the incredibly bullish, meaning that there's very low amounts of cash levels that these fund managers hold. And then above 5% means that they're holding more above average cash, and that they're a little bit more fearful, right? So they're a little bit bearish on the markets. But as you can see right now, It's at 3.8%, which I think that's the lowest since, maybe 2013. So that's an incredibly bullish, signal from fund managers. Now, some might point to that and be like, "Hey, that's typically when things top out." Um, and you can see this compared to the April 2025, tariff tantrum lows when this almost went to 5%. So it's below 4% right now. So this is typically a good time to start taking some profits when we get the chance at the top end of the trading range on select bullish assets. But it is interesting seeing that fund managers are extremely underweight in their cash positions. When it comes to overweights in their positions, gold became the most crowded trade for the first time since June. And after that is long the Mag 7 stocks. So essentially, gold and the top, Mag 7 stocks have been the largest allocations by these fund managers. As you can see, long crypto has actually come down a lot, and short US dollar has also come down a lot, which makes sense as we've been talking about the dollar going bullish trend in our model for the first time since the end of July there. And then lastly, when taking a look at their, what they're most fearful of, right? So these fund managers, the most that they're in fear of is this AI equity bubble, and the second is inflation coming back. And as you can see, the lowest right now is trade war triggering a global recession. That's actually the lowest fear right now, according to fund managers. And that's been a pretty large reversal over the past 3 months, right? You can see at the beginning, or you can see that for August of 2025, just a couple months ago, trade war triggering a global recession was the biggest fear. And let me see here. And then Fed losing independence was the worst. So yeah, it doesn't really matter to myself and my team. It's just interesting seeing the sentiment there. But that's really where the big boys stand, right? So the people who have the most amount of assets under management. So it's good to get a temperature check on the sentiment from the people who have billions, who are managing billions for their clients there. All right. Yeah, we can go ahead and touch on some of the key things here, and then get into what's actually coming up this next week. Taking a look at the S&P 500 ETF SPY, looking at our trading range model, we can see that on Friday it closed right at the top end of the trading range at $677 per share of this ETF. And the low end of the trading range is between 657 and 661. Pretty far off there. And so on Friday, it was a great time to take some profits there if you were long. What's interesting is that, this bounce has been on lower volume, but, volume actually picked up a little bit on Friday. So we'll see what happens from here. Pretty much the whole month of October, has been characterized as a like a low volume or bearish divergence month. This indicator that I have below here is the net average volume, because sometimes the built-in volume indicators that are on some of these charting platforms are a little bit harder to read or actually get the actual trend. And so what we built was this average volume indicator that essentially shows the cumulative volume average between different time frames. And so this green one here is the average on the previous week, and then the blue line here is the average on the previous month. And so typically when you have the 5-week average or the week average above the monthly average, that's usually a volume acceleration. And then when it's declining below that, that's typically a volume deceleration. And so, as you can see, ever since October 16th, the 1 week average has been decelerating, and right now it's actually below the 1 month. So that typically shows a volume deceleration. The last time we saw something like this was in lead up to the large sell-off that we saw on October 10th, right? So you saw right here how We saw the bearish divergence at the top end of the trading range. Great time to sell some at the top, and then boom, you had the large acceleration on that price drop, and then it went right down to the low of the trading range, which was a great time to just wait and watch. You had a couple days where it remained near the low of the trading range, and then you had some volume drop there, but it still remained in bullish trend, and so our group says to buy it at that point. And then you had a nice little bounce here where you can now take some profits on lower volume. So we'll see what happens from here. This isn't to make predictions. It's all about risk management, right? So when our team says sell some, that doesn't mean we're bearish on the S&P 500. That means we're just trimming a little bit in order to risk manage if we do get another sell off to the low of the trading range, which we'll just add back at that point, right? Doing that serves two functions. One, again, you're risk managing, and two, if you're trimming some at the top and then re-entering at the low of the trading range, you're also compounding your results, right? So it serves dual functions there, and it really helps you sleep at night, at least for me anyway. So interesting seeing that there. Taking a look at the US dollar, DXY, that still remains in bullish trend, which typically, does wreak havoc on some international equities, but it's funny how emerging markets have still held up. Some have actually fallen off, but there are some emerging markets that have been doing better. I know that we had a bit of a rebound in gold. Let's see if I can find it here. Too many tickers on my... Too many tickers on here. Silver looks like it's going to continue its correction. Could possibly get an opportunity there. It's still holding its bullish trend, but it's lost a lot of momentum. Same with gold here. Looks like it is opening up in the red. So we'll see if this continues lower. Gold. Part of the reason why it's been doing so well is because the market has been pricing in more of a stagflationary environment, as well as fiat currency fears. And so if you have that optimism come back as well as growth accelerate, that could take away some strength from gold. So that's part of the reason why we want to see if this soft landing narrative by the market continues to increase from here, because that would actually be more of a headwind for gold. Bitcoin, we'll see if it gets out of its bearish trend here. It's looking like it's trying to. Still not yet out of it, though. We'll see where it closes. I would like to see it above 116.5K. We'll see if it gets that, though. Still just remaining patient on whether or not Bitcoin decides to continue accelerating from here. We already talked about the S&P. Yeah, Google, NVIDIA, a lot of the Mag 7 still remains in bullish trend and continuing to do well. Like we mentioned before, the tech sector, utilities, and healthcare have been the best sectors this month. And then I continue to see a slowdown or a deceleration in net central bank liquidity here. And so I saw on Twitter, actually, or on X, the past few days, how a lot of these, crypto gurus have been saying, hey, Jerome Powell just came out saying that they're ending quantitative tightening in the next coming months. That means they're going to start QE and the money printer is going to come back. Bullish. Now, that with quantitative tightening ending, that doesn't necessarily mean that QE is beginning, because they're two separate things, right? QE is letting assets roll off their balance sheet. QE is actually adding things on, but if they're not doing either of those, then they're just letting their balance sheet sit. Now, part of the reason why they are stopping QT is because they've ran out of liquidity in the reverse repo facility that's essentially been pumped into the markets for the past for the past 3.5 years, right? So after the pandemic, they stored nearly $2 trillion in this cash parking lot that's held at the Fed, and this has been drained nearly all the way. And so this cash reserve is completely used up. It's partly why liquidity conditions have been very favorable and the market has been, ripping, is because of this. Some of that went into the Treasury General account, which is at its cycle highs here at 900 billion, which is pretty interesting. That's typically a liquidity drain, and so it looks like the government has loaded up on their cash balance, and if that gets deployed, that could also be like a last minute cushion for liquidity in the markets. And then looking at the third component, which is bank reserves, that's actually at its lowest point since January of 2023, and that looks like it's continuing lower. So that is very interesting too. The combination of those three things is what's contributing to net central bank liquidity continuing lower. And so the Fed's like, okay, if liquidity is starting to get squeezed a little bit here, we probably don't need to continue rolling off assets from our balance sheet. And so that's why they're stopping, right? And again, that doesn't automatically mean quantitative easing is going to come about just because they're stopping QT. In fact, Jerome Powell has guided in previous Fed meetings stating that we wouldn't even do QE until something crazy happened, and it would be after the fact that we dropped interest rates all the way down to zero again, right? And so Jerome Powell has explicitly guided, and who knows, maybe he's lying. He's definitely lied before. But, he's guiding to the markets like we won't even do QE until we drop rates to zero, because that's really what the quantitative easing measures were created to do back during the 2008 Great Financial Crisis. They couldn't lower rates any more than zero. And so that's why they did QE, because when you look at the net, it's almost like they did negative interest rates in order to stimulate the economy from the global financial crisis. That's why they did QE, because they can't lower rates below zero, right? And so that's really the modus operandi, right? So first rates would go to zero and then they would do QE. They're not going to do QE with still rates this high, essentially. All right. We beat that horse to death. Let's go ahead and go into what we're looking at for this week. We have some home price indices. The Case-Shiller from the S&P Global, that's been decelerating. Wouldn't be surprised if this might have a little bit of an acceleration just looking at existing home prices. We'll see what happens there. We're not going to get the regular home price index from the Federal Housing Finance Agency because of the government shutdown, but the S&P Global one should be all right there. We have some more Fed bank data here coming with the Richmond Fed Services Revenues Index, the Dallas Fed Services Index. We'd like to see, if you're someone who wants to see more of this evidence of a soft landing, you would want to see this continue to rebound from here, which had a pretty decent deceleration in September. Services revenues declined in September, so you would want to see a rebound there. Pending home sales had a decent rise due to rates falling. We're getting more of that this week. And then, of course, we have the Fed meeting on Wednesday. Jerome Powell will come on TV and have his press conference starting at 2:30 p.m. Eastern Time, which we'll go live for on this channel. So for those who are joining us on our YouTube or X account, hit subscribe so that you guys are able to join us for that. We typically do a live reaction, a live market reaction to the Fed meeting, as well as I like to do a little bit of commentary to translate some of the bank talk and some of the BS that comes out of Jerome Powell's mouth, because they want to make it seem like they're the friend of the American people, which you have to remember, the Federal Reserve is a banking cartel that's legal, okay? If you go ahead and study the history, they can pretty much do whatever they want. And yes, they are appointed by Congress, but really their actions are completely separate from what Congress and the president want, even though they get appointed by them. And so they're arguably the most powerful entity outside of the executive presidency branch in the United States. And so, Yeah, they like to pretend like they like to say on TV that they are doing their actions in the best interests of the public, but they're actually not. The whole point of the Federal Reserve System is to privatize gains and publicize losses. Right? This is essentially what happened during the 2008 Great Financial Crisis, where all those banks and all those people, not one person went to jail. They bailed out all the banks, and then instead of holding those banks accountable, they essentially said, you know what, we're just going to inflate the currency away and put all of this burden on the backs of the taxpayer, and they will take the brunt of this financial atrocity. And that's really what has been happening over and over again. That's kind of what happened as well during the pandemic when a lot of banks went under, as well as the 2023 um, bank collapse, regional banking crisis. No one went to jail, and they're essentially just inflating away all of the losses, right? So you and I pay for the losses of these private bankers. That's how the system is set up, which again inflates and devalues our purchasing power, which means that you have to own assets in order to have any type of fighting chance with these out of control banking cartels that are the true evil in this world. So whenever you see Jerome Powell get on TV and say, "Oh, we're in favor of lowering rates because we're for the American people," it's all a bunch of crap, like pure evil. Anyways, taking a look at the probabilities of a Fed rate cut from now until I believe the last time I looked, let me see if I can reload this, until I believe it's February. They're going to do three consecutive 25 basis point cuts from now until February. Let me just go. And this isn't set in stone. This is just what the futures market is pricing in. Okay, yeah. So they're going to do three 25 basis point cuts till February, and then the next cut won't be until the June meeting of 2026. So it looks like they're going to cut three times and then pause for a few months. That will change if we continue to get weakening jobs market data, but that's currently what the futures market is pricing in. And typically, as we get closer to the Fed meeting, the target rate probabilities are pretty accurate. So I wouldn't be surprised if they cut by 25 basis points. That's what's being priced into the market already. Because of all these tools, the actual Fed rate decision isn't the surprising thing, even though they could surprise if they wanted to. But it's not so much the actual Fed rate decision that matters. It's the commentary and the forward guidance by Jerome Powell in the press conference and how some of the journalists ask questions. Typically, it's meaningless. I typically only look for like one question that is good. And that's typically what happens. So we'll see. We'll see. It's still fun to see the market reaction and stuff like that, and kind of just tear away the veil that is the Federal Reserve. Even the website, they make it boring on purpose so that you won't look into it. But anyways, and then we also get the Chicago PMI, which is another leading indicator for the manufacturing sector on Friday there. And then we'll see what happens if there's any type of resolution with the shutdown. I don't think there is currently, so it could be heading into the first week of November, which, as we know, the first week of every single month is jobs data. And if we get another month of no jobs data, I don't know. I guess the market will just continue higher. Pretty busy earnings week this week. Last week it was kind of interesting as well because we did have Tesla as well as Netflix. Tesla had a pretty interesting week. Let me just go over to the charts here. Bring it up. Tesla. Yeah, so as you can see, it had some bad earnings, but then the next day it had a pretty crazy bounce. So Tesla, even though the headline said bad earnings, in our model it still remains in bullish trend. Excuse me. So when something is in bullish trend, you want to continue to look for adding opportunities at the low end of the trading range. And so what's interesting is that on that candle, post earnings for Tesla, it went right down to the low end of the trading range, and then had a huge bounce from there. So the ranges win yet again. But this week, though, we have some pretty interesting action with earnings reports here, just bringing it up. So we have Apple, Microsoft, Google, Amazon, or no, wait, let me see here. Yeah, we do have all those. But we have Microsoft and Google, as well as Meta on October 29th. So that's on Wednesday. We have Apple on Thursday, as well as Amazon. And then Eli Lilly is on Thursday. We have some of these large credit stocks as well, like Visa and MasterCard. And those are on Tuesday and Thursday. And then ExxonMobil is on Friday there. So yeah, 1, 2, 3, 4, 5. 5 out of the Mag 7 are reporting this week. So this is a pretty crazy week in terms of earnings. Apple, Microsoft, and Google remain in bullish trend. Google making new all-time highs on Friday there. And then we do have Amazon as well as Meta currently in bearish trend in our model. So it will be interesting to see what happens with those two. So pretty busy week in terms of earnings and some of the data that we just looked at here. I'm trying to see if there was anything else that I wanted to touch on before we went ahead and closed it out to continue with the second half of this offline for just our members, where we will be discussing some actual ideas and tickers for based on all this data here. So yeah, that's pretty much all I had. So for those who are on the Zoom call, stay put. I'm going to go ahead and close out on the stream. So let's all wave goodbye to people on YouTube, Instagram, TikTok, and X. Good luck out there, and we will catch you guys on next week's Sunday Macro Wrap Up. Bye, everyone.